How are you looking at Thursday? What's the ECB going to do?
Well, as you say, it's a very close call for next week. They've got quite a dilemma on their hands. So first of all, if you look at the activity data, it's already been deteriorating and probably quite quicker than they were expecting. If you look at the PMI surveys, they're already looking at contraction for manufacturing and services. So there's very poor growth outlook there, as you've already mentioned. But on the other hand, if you look at the labour market, still very tight, wage growth, wage pressures there. And if you break down the inflation components, yes, we're seeing some deceleration across core goods prices. The core services, I think it's going to take some time to really decelerate. So there's a real dilemma there for the ECB. And we can see that in some of the communication that we've had recently. So in the last monetary policy meeting, the policymakers agreed that they wouldn't actually signal in either direction whether it's going to be higher or lower from on hold or hiking the next time round. However, there's a lot of dispersion within the views. We've had some hawkish comments and endorsement of hikes from Martin Kazaks, from Holtzman, Casimir, and Nagel as well. So there's a dispersion there of views, and you can see that because of the data and the divergence there. It's going to be quite as you say, a communication nightmare ahead. Overall, we think they will be on hold, but it is a close call for next week.
How do they, if the market sees a hold, does it see cuts coming soon, Sree?
I think it's going to be difficult to cut too quickly, given where inflation pressures are. And this is a common theme for central banks, major central banks, over the next few months. As the data deteriorates, unfortunately, they do need to focus on inflation as well. So I think it's going to be some time before we start to see cuts either from the ECB or from any of the major central banks. I thought there was a very interesting comment from Hugh Hill from the Bank of England quite recently, where he talked about Table Mountain rather than the Matterhorn in terms of the profile for rates. And I think that's quite a good analogy to bear in mind.
I laugh because you literally just made Guy's day. We had the Table Mountain Matterhorn conversation like a few months ago, and I was like, what's Matterhorn? And we had it's a whole explainer. There are graphics, there are pictures. And then when Hugh Hill said that, we both got very excited. But to that point, how do they communicate, though, softer inflation but softer growth, but then not do anything about it? Like, how do they have a hawkish pause? How do they have a dovish hike?
I think what we're likely to see is potentially they hold open the window for another rate cut, possibly in November, if they do hold next week. So I think that will be the hawkish signaling that we could get, potentially. Now, the focus for that will be specifically the labour market. If we were to, there's been a lot of talk about plotting inflation or wage pressures against the unemployment rate. And, you know, the Phillips curve and the steepness of the Phillips curve. I mean, in Europe, you know, the labour market, the adjustment in the labour market, the frictions in the labour market, they're still at a very early stage where we're starting to see some turnover in the US, perhaps. We're not really seeing that easing of wage pressure and service sector inflation pressures in Europe as yet. So that's really the focus, I think. Whenever we hear these hawkish comments, then that it's really that focus on core services that's the key problem.
Sree, what happens if China delivers massive stimulus? What effect does that have on the European economy?
I think we've seen some stimulus from China. We're not expecting the 2008, 2009 style, savior of policy from China, unfortunately. I think what we're seeing at the moment is in China, we've had some disappointing data in China. We've seen some tweaks around the policy edges, really. Mm-hmm. But they have got some structural problems there in terms of the real estate sector. That rebound that people were talking about earlier on this year, that post-zero COVID rebound, we had flagged earlier on this year that would be quite narrow. And what we're seeing now is exactly that. In manufacturing sector, demand has been relatively weak. Real estate sector continues to be weak. The rebound that we're seeing is in travel. And that's something that does have some spillovers for energy prices and for the regions, for tourism across different regions. We've seen that in Japan, for example, a pickup in GDP last quarter in Q2 was part of that was inbound tourism driving that recovery. So it's very, very nuanced story in China.